Hi everyone, this is Michael Bengiat. This is the Market Trend Advisory Weekend video for April 23rd, 2022. Before we start, here's our disclaimer. You can pause the video and read this. Let's go ahead and get straight into the market trend. Well, we had quite a change this last week, especially the last 2 days, on Thursday and Friday. Basically, the whole market is turned into back into a downtrend and a correction. The S&P had been hanging in there for a bit, mostly because it has a little bit more of cyclical stocks, industrials, things like that. Nasdaq's home to mostly tech stocks, which have really been getting the brunt of the selling. But in any case, the whole market in the last couple of days just really reversed once Powell kind of came out and said they're behind the curve and need to raise interest rates probably faster than the market was hoping. So at this point, we have no exposure to the market. We've even moved our individual stocks, non-index ETFs, action signal to no positions. We got stopped out of all of our positions on in stock picks, our other service, mostly because we moved up our stops pretty close to protect against the downside, and we would have had much. We actually ended up making a little bit of money on this last round, not much because they all reversed on us, but it's better than losing. And the ones that did lose were very minor. So really no major loss or anything there. And basically, let's just call it even. So again, we have no exposure. Market count's 0. In fact, the Nasdaq had 3 sell signals. There was actually an additional break below the follow-through day signal, which I updated our main database. But we had even a circuit breaker, which is sort of a fail-safe sell signal, in that sometimes, depending how the market is structured, we might get really big down days, but maybe we're not breaking below key moving averages, or we're already below moving averages, but we still have some exposure. Anyways, that kicked in, just even though it didn't really matter because we were already at 0. And again, that's why the system really works well, is that we were already at 0, and then we basically avoided this whole carnage that happened on yesterday and Friday. We're also getting more institutional selling days in both indexes, especially on the S&P, and we're at 7 now. And part of the reason why the S&P has moved to 0 is that we're getting the big institutions are slowly but surely starting to sell, and they're selling in closely spaced days now. And that's one of our sell signals is called distribution cluster, where you're getting a number of days within a rolling 8-day period. So anyways, it's all adding up to just a market that you really shouldn't have any exposure to, and is really not healthy at all. So we're going to go back in just a few minutes. We're going to look at all the little the sentiment and the technicals, but we'll get to that in a second. For our investing strategies, it's been a little bit of a tough run, just because we had such a massive run off that follow-through day, and the ensuing days after that kind of really kicked us up above all the sort of our signals that would have normally got us out, and then we've chopped around quite a bit. So I think we're actually better than with our QLD, the 2 times leverage. We're better than the QQQ now because we're out and it's continuing down. But still, we'd like to see a better return than that. The 3X is we're also out there too. But because it's triple leverage, that's really not bad in this environment. It's pretty bad. And then for the SPY, it's kind of held in there a little more. The S&P headed down again, and we are out as of Friday too, because that was actually showing quite a bit of strength. We were at 55% invested just a couple days ago, which was this is how this market has been. It's very tricky. It's giving off all sorts of buy signals, but as we've talked about for months now, under the surface, it's really been rather sick, and we just seen institutions selling into all the rallies, which is why so many stocks they break out and they just fail. In some cases, they fail spectacularly. So that's the environment we're in. So let's go take a look at, here's the Nasdaq. And you can see here we had our initial bear market. As soon as we got down about 20%, whatever reason, traders, investors, hedge funds, whoever it was, all piled back in. we had this massive 4-day up move, which was one of the most powerful up thrusts that I think we've seen in the last 80 years or something. But this is classic bear market action. This is what you see in bear markets. Just huge short covering, and even look at the volume on this one day here. So, but it turned out to be all for nothing because even though we blasted right past the 50-day, which is this red line, which was downtrending, and we couldn't even get up to the 200 before the sellers came back in. Didn't even touch it. So really showing quite a bit more weakness than you think. And then when we came back down, we tried to rally above the 50, got immediately returned out. So sellers were just waiting there to get out for the institutional sellers. And then we've broken down, we've broken below the follow-through day, and it's very likely we're going to test these lows, if not break them and head lower. At this point, it does look like this market correction is nowhere near done. And it could be, we were in for a much larger extended bear market, which would make sense. Let me just go ahead and skip one chart, because here's the monthly of the Nasdaq. We've shown this quite a bit, and we have this trend line, and we have the market, repeatedly since 2010 would get up to the upper part of the trend line, which showed the market was a little bit extended. We'd have a pullback, sometimes a little bit more than others. Sometimes we hugged it. None of these corrections were, I think maybe the worst one was, we had a bear market here. This was a shorter one. Then we had the coronavirus crash that really took us down, I think 35%, but it just came roaring back in just, weeks. And then we went into what's probably, historically, we'll look back on this as an extended parabolic run. We went above this trend line, and we stayed up there for over a month. This is a big warning sign. And in fact, if you look at this, if I had looked at a lot of the stocks, you'll start seeing right at the end here is where we started entering in the really bad bear market in many, many Nasdaq stocks. We've just about to break below, and I've drawn a line here. This line here is right at this 40-month moving average, which is, the market's gotten support there, over here. We did break it here, but we managed to close above in the coronavirus crash. And then we came down again right to it and got support. So this is a very important line. Unfortunately for the market, there really isn't any support till that level, and that's 1,600 points lower in the Nasdaq. So I would actually look at that to be maybe the target for the Nasdaq if it continues down, which looks very likely. So let's go back to the S&P. S&P has held in quite a bit better, but this was a pretty ugly day on Friday. And again, we had these massive up days, and this showed that the S&P it posted 4 consecutive gains of at least 1% in this move here, where the arrows are, and that's only happened 4 times in 85 years. That again, hallmark of a bear market, and it just shows you that it's very easy to get faked out by what happens to the market, especially when you get these kinds of moves, because it just starts looking like, oh, we're off to the races, and up we go. You can actually see another one over here. We had a massive reversal on this day here. Looks like the market said, that's it, we're done going down. And then we had 4 days again, it kind of did the same thing. And then we came down and made new lows, and another huge up day. I mean, this market, this is actually also very powerful topping action that you see when a market finally tops out for an extended period, because it doesn't want to go down without a fight. And you can see it in the Nasdaq here. We kind of almost broke the new lows. The buyers piled back in. We're about to break down. It's probably going to be a little bit of a fight here. If it really just crashes through here, that's a very bad sign. But we'll see what happens. But we're just getting all the signs of an extended top that is not going to just turn around and make new highs anytime soon, especially when you look at many of the leaders, which I'll show you in just a second. So here's our example is the ARK fund. This is Cathie Wood's flagship fund, investing in all the disruptors. And you can see, it had a nice run in 2016 when it came out, had a little turbulence here in 2018, 2019. Then, of course, after the coronavirus crash, it just went on a massive tear. I forget, it was up maybe up 200% or something like that. But you can see it's wiped out all of the gains since the coronavirus crash. And look at the volume. It looks like this, when you see these charts many, many times, they go well below this point, and sometimes they actually go below the whole move. So that would be if we're really in a nasty bear market, but likely this will continue lower and will probably wipe out this whole move also. It's just, and she doesn't have any, we've talked about this before. For somebody managing, billions and billions of dollars, she doesn't have any risk control. She's down 50, 60, 70% on some of her positions and keeps buying. And then I actually just read that the money's still piling into this fund. People are saying, oh, I didn't want to buy it when it was over 100, but now that it's 52, I'm going to get in. That's the recipe for losing most of your money, is buying falling arrows. I mean, sure, this went over here. Oh, this looked good. It looked like it had bottomed. Let's buy it here. No. Okay, let's buy it over here. Well, here we're just getting months, 1, 2, 3, 4, 5, 6, 7 months down on massive volume. That's buying a falling knife if I've ever seen one. I'll take another look quickly, just PayPal again. This was a market darling. It has wiped out the complete move over the last 2 years. Not even quite sure why. There's many charts like this. They're all getting hit because they're were extremely, I'll call it overvalued, but at the time, the market was assigning multiples to these kind of stocks. In some cases, pretty ridiculous multiples that, looking back, we saw that in the internet bubble years where, the metric was how many eyeballs are coming to the site. That was what the valuation was based on the eyeballs. Nothing really, concrete or anything really in reality going on there. But again, we also saw so much, and there's been so much money pouring into the market. I think that it's the reality is coming back in a rising interest rate environment. These super overvalued companies are really starting to pay the price. So let's just go quickly to keep this video not too long. Let's take a look now at just some of the technicals. You can see here, just starting from April, it was looking strong again right when we started to go and make those big moves up. But you can just see here, looking at the various indexes above the key moving indexes, like the moving averages, the 50 and the 200 day, and whether or not the indexes are aligned. What we mean by aligned is that you'll have the 200 at the bottom, above that's the 50, above that's the 21 day, and even the 10, which is very, very, very short period. And you also want to see them all nicely aligned and heading up, so you're heading towards the upper right corner. We briefly had it in the Russell, which was the small caps, and the S&P 400, which is the mid caps. They kind of were showing a little bit more strength because a lot of the oil and gas stocks, things like that, were kind of in these sectors. But for the most part, you can just see that really the market has not been healthy for a long time. If you can go back farther, you'll see it's been a lot of red. Let's take now a look at the other technicals. Actually, one thing I wanted to show, I don't think I can do it here, but we'll take a look at the 52-week highs and lows. And you can just see, even though we were been rallying and showing a lot of strength, overall, the number of 52-week lows has really been more than the 52-week highs, especially since starting about the 1st of April or so. And we're really getting a pretty, look at the ratio here. In fact, you just look at the ratio. You can see that we had some green, orange, and then it just kind of, a couple days, we have really strong days, and then it's just been creeping, lower and lower and lower. You can see the Nasdaq, again, was 6% above its 50-day. Now we're down 6% below its 50-day. Above the 200-day, we're at the lowest point. This is getting a little stretched, but we don't seem to have any impetus to rally at all. This column here is just showing the number of growth stocks that are leading the market that have broken out but haven't failed yet. And again, we saw a nice move over here when it was looking strong, and then we're kind of just creeping down. Sometimes we get jumps up because we get a lot of the defensive stocks that start appearing here. You get the utilities and food companies and things like that. They just start appearing in these lists because money's going into those sectors that considered safe. And then also here we have the up and down volume, and we're getting just a lot of days where it's more. So really not a strong market. It hasn't been for a long time. And then finally we have sentiment. Now, this one's interesting, is that we haven't reached, even though we've been heading lower and had some really down days, we haven't reached that level of sentiment where we had back in when we where were we? Sorry, go back here. Yeah, when we were back here in the middle of March, where it was pretty black, the sentiment, and we just blasted off. We're not anywhere near that right now. In fact, this is just the bulls and bears are basically neutral. The CNN it was mostly neutral, kind of going towards fear, but we're nowhere near the panic level we saw. The VIX has been a very strange for a long time. It's just been red because normally the market has been down, around 15. It gets down to 10. You're kind of, usually that's where the market starts to maybe have a little bit of a correction. But we've been for months and months and months. It's just been red. It's very odd. Not really find a lot of reasons why that's been this way. But anyways, sentiment's been just strange. We've had some sectors like the American Association of Bulls and Bears. Sometimes that gets super bullish or super bearish, but this doesn't confirm. The CNN does have a lot of other elements to it. It does have some bond. There's some sentiment built into that. There's I forget all the things it has into it. But anyways, that's been a little odd. But add it all up, we probably have some more downside, at least until sentiment gets to the level that the buyers just come piling back in. But we don't seem to be there yet, so I would expect further weakness. And then finally, just really right now, it's all about interest rates. The bond market is pricing in higher interest rates than expected. Like for mortgages now, we're starting to see, people just getting priced out because they're about 5%, and people were getting 3% or under just not long ago. That's a really big move in a short amount of time. And because the markets are discounting mechanisms, they're also pricing in higher rates faster than expected. And this is the problem that's going on now. On Thursday, it started off this last plunge. Fed Chair Powell just all but implied that they're behind the curve and going to be increasing rates quickly. They're looking at probably a half point, which the market wasn't expecting. And in fact, some of the Fed governors they're trying to call for a 3/4 rate. And what's interesting is that the market hasn't even done any of this yet. It's always looking forward. So it's not liking what it's seeing. In fact, it may be thinking that the Powell is way behind the curve with 40-year high inflation. This interest rates may have to go much higher. Plus, he's also reducing all those bond purchases, the trillions of bonds. They were buying $120 billion a month for years, and they're starting to cut that back. You cut that back, and now you have that pressure lifted, and rates are going back to market levels and what they should have been doing for years. And then also the market's a little bit worried that the Fed put is no longer in place, which has meant basically the Fed's always had the markets back. This should say the Fed. Let me change that right now. And that's something that's gone on since Greenspan. As soon as there's any trouble, the Wall Street would just head over to, the Fed's office and say, "Hey, we're in trouble, and no problem. We'll just cut interest rates." Well, it looks like that's not happening anymore. In fact, it may not happen for a long time. Also because interest rates went, negative. So when you add all this together, really the valuation of stocks is dependent on the relationship of their growth and inflation. And then when inflation is higher than growth, well, you start seeing that investors will head towards more predictable returns in the near future, as opposed to the speculative growth stocks whose future is less certain. And that's what we've been seeing for quite a long time. That's why all these very highly valued tech stocks and growth stocks have been just getting pummeled, while the money's been moving into oil and gas. At least they show with high oil prices, they're showing very strong profits and margins and sales, and they're moving into other defensive areas. And So the rise in the 10-year bond yield, it's also showing that indicated companies are going to need to increase their cash flows in order to retain their stock price levels. And so again, that's back to the same thing. It's at the heart of why this market is falling in an inflationary environment. Is that that's the thing, is can companies continue to retain, increase their cash flows and keep sales and margins growing in this kind of environment? And that does seem to be an issue, especially with, at least on Friday, we had a number of companies came out that really showing that it's starting to affect them and their pricing and their customers. We even saw Netflix really lost a lot of subscribers for the first time in many years. So we're not getting great reports, and that, I think, exacerbated the whole sell-off. So it doesn't look like this is going to get resolved anytime soon. So I think our expectation should be that the bull market, at least the roaring bull market we've seen, is probably in the past. But we'll see. Anything can happen. This is the stock market, and we will just continue to watch. But at this point, in the near term, it looks like we have very little impetus to have a rally happening anytime soon. We do need to wait for a follow-through day to happen again, since we're in a correction, and that wouldn't happen until we're at least 4 days from a initial rally attempt, which we haven't seen. So I think at this point, if we got it on a Monday, the earliest we could be back into some kind of a rally would be Friday. So anyways, we'll know more next week, and we'll be back next weekend. Hope this is helpful, and talk to you then. Okay.